Hey, what's up you guys? Max here. What can you expect in your first year of investing? Today I reveal my complete amateur portfolio for you guys. Now let's get started. So in 2020, I decided to open up 4 brokerage accounts. One was WeBull, I had Robinhood, Fidelity, and finally MY Finance. And today I want to share with you guys my WeBull portfolio. It is by far my largest holding. And later on, if you guys are interested, I will share with you the rest of my portfolios as well. And all the different portfolios and brokerage accounts, I really just wanted to figure out which app best suited me, which style best suited me, and I also implemented various investing strategies on all those different platforms. So if that's something that you're interested in watching, let me know down below. Now, one of the main reasons I started a YouTube channel was actually to do more research on my stocks. You see, every time you post a video, you do so much research to actually give relevant information and give people something useful. So that continued to push me to do further research and to improve my investing strategies altogether by actually being put on the spot by you guys that are watching these videos to be more accurate and better at investing as well. So that was the main reason, and why I say that is because the most important things when actually buying a stock or considering what stocks to buy is doing your research on the company. It's very important to understand the company. It's very important to get a good or figure out a good target price for the company and then act on that target price. And the list that I'll show you today consists of almost 50 stocks, and they're ranked based on my highest return in terms of dollar value, not percentage. So it's a combination of putting my money where my mouth is and also a combination of the highest return possible, because some of the other percentages that we'll see as we go down the list might be higher, but I didn't end up putting as much money into it because it was either a speculative play or something that I just didn't really believe in, but thought I'd give it a go. Because this was my first year, I really wanted to figure out what kind of investor I am, and I didn't invest too much money into any particular company, and I was very well diversified. And like I mentioned, this is one of my brokerage accounts out of 4, so I'm very well diversified, and there's plenty of reason for that. Now quickly, before we get started, when you see a percent such as 100%, that means my investment has doubled. And when you see 200%, that means the investment has tripled. Now let's dive in. So looking at the very first stock here, it's Lemonade. This has been a great performer for me. And the reason I actually got in this stock is I ended up buying renter's insurance this year when picking up this place actually that I'm currently filming in. And they actually required renter's insurance. So I figured, okay, let me shop around. So I stumbled on Lemonade, and I was just blown away with their user interface. Was just absolutely amazing. I couldn't believe how quickly and easily I was able to sign up. So that was basically enough for me to do the research on the stock. And what I'm gonna do here is I'm quickly gonna give reasons to why I actually started to look at these companies. And then actually for all of these companies, I ended up doing due diligence where I researched the stock price and figured out my target price for each one of these stocks. And if you want to learn how to value any stock out there, after this video is over, definitely go into the description down below, and I've left a link for you guys on how to value any stock out there, whether it be a dividend stock, high growth stock, or just a regular stock of a tech company, and so on. So check it out if that's what you're interested in. So back to the list. I'm quickly gonna tell you why I started to research these companies without actually getting into all the math that I did behind them, but what gave me that first initial impression. Just like you go out on your first date or anything like that, you gotta get the initial spark, and I will share with you guys what sparked my interest in these companies to actually go ahead and do my research and compare them against their competitors and choose them over their competitors. And my goal with this is just to tell you what made that initial spark for me and why I actually decided to research the company further. So yeah, for Lemonade, it was definitely the user interface experience. I thought it was absolutely amazing, and this company was destined for greatness. So that is why I started to research the company. And it has done amazing for me, returning 220% since I purchased it, and I didn't even buy it that long ago. It was definitely midsummer towards the closer towards the end of the year. So it's definitely amazing to put $600 in and then get 1,500 back from that. That's an amazing return on this company. Really happy. We'll be adding to it later on. However, for now on, I'm just gonna hold off because I do think investors have piled into this company far too quickly. So I will hold off until the interest dies down and I will begin buying again. Now, moving on to Google. I absolutely love Google as a company. I think they have a great management team. And although many people don't agree with my choice here, I think they are destined to do great things, and they're continue to returning a safe 20% for me year over year over year. And so far it's looking good with Google returning 19%. Pretty happy with this. I do think they will do much better, especially with new monetization rules on YouTube and all the other areas that they're trying to raise revenue in it as well. Walt Disney, who doesn't love Walt Disney? Definitely picked this up because I thought it was completely unfair how Netflix was trading so far out of this world. Basically, it was traveling to the moon, whereas Disney, who just launched their platform, were way undervalued. And I understand that they were getting dragged down by all of their theme parks and stuff like that. However, they did just launch Disney, so I couldn't believe that investors didn't see the growth potential in Disney. So I ended up picking up a bunch of shares. We'll be holding this definitely for a really long time, and we'll be adding to it further. Now, I noticed M&T Bank and how low they're trading, and then I did a comparison with all of their other competitors out there, and it looked like one of the best investments out of the category. And since I wanted to buy some bank stocks, I definitely decided to invest in M&T Bank, which saw a 53% return. Tesla. I'm not a huge believer in investing in Tesla, and lots of people might criticize me for that, and that's okay. That is my personal opinion, and I'm not a financial advisor. But I did end up picking up one share, which has been doing extremely well for me, almost returning 100%, and I picked it up just before the battery day. I was like, oh, this will be a quick way for me to make, I don't know, X amount of money, because I thought battery day will go really well. Battery day ended up going pretty bad. The stock was down pretty significantly, and I ended up just holding it, knowing that investors of Tesla will just keep buying the stock and keep buying the stock, and things will return back to normal. But to my surprise, I'm sitting at almost 100% for the stock. Really nice to see. And part of the reason why I wanted to buy it is I often get, as a new investor, I often get caught up in fear of missing out, or just wanting companies to do badly just because I don't own them, but then I want them to own them. And I think that's a very negative outlook on investing. So I wanted to pick up a share so I have some kind of stake in it. And I actually want to root for Tesla, Elon Musk, to do great things. And at the end of the day, if they completely fail and their investors pull out and the stock goes down 50%, at the end of the day, that doesn't hurt me whatsoever because it's such an insignificant portion of my portfolio. Now, I picked up Redfin because of their insane data on real estate. I think they're doing extremely well, and definitely did my due diligence, but that's what started the initial spark, and why I got familiar with the company is their data on real estate, and why I think they're gonna be the next up in terms of the real estate game. Definitely will be purchasing more of these later on. Uber and Lyft I ended up purchasing during all of their lawsuits this year with California. I thought that was unfair, and that Uber and Lyft will definitely figure something out, and they were unfairly punished. So I ended up picking up both. Uber does see a smaller percentage return, but I did put more money on Uber than I did on Lyft, and we'll get to Lyft later on. So Uber returned me a nice 60%. United Airlines, now I did want some recovery stocks, and I own a lot more shares of recovery stocks on my other platforms, but I wanted to pick some up on this one in particular, just because for my Fidelity one, that is my Roth IRA, and I couldn't add to it anymore. So I ended up picking up some shares over here as well, because the stock was being punished beyond my belief. Fairly punished, really, but I did definitely see the potential in the recovery. So I saw a really nice 65% return on this one. Carnival Cruise Lines, again, this was a recovery play. So it saw a 64% return. That was also really nice. And for some of these companies, we do have a really long list to get through, so I will be rushing along through some of them. If it was a quick idea such as a speculative play or just a recovery stock bet that I was doing, I will treat it as such. But if there was actually an interesting purchase such as Lemonade, I will definitely discuss it further for you guys. ExxonMobil, yeah, I definitely wanted some dividend stocks and some energy stocks. I do not believe in energy in the long run, but these companies, you gotta understand, like Shell, ExxonMobil, and so on, they do invest a lot in renewable energy because they are worried about gas declining in the near future. So that's definitely something to keep in mind when investing into these companies. But I do want to keep a very low profile of my energy, gas, and so on sector for the time being for the next 10, 20 years, because I do think it's gonna keep declining year over year, but it is gonna increase in 2021 and 2022 because of the return to work, and a lot of people are gonna start commuting a lot more as well. Now, Amazon, very modest return here. I ended up buying it in my other portfolio at more of the lower sections, and then I saw a really nice return on Amazon, so I ended up picking it up on this portfolio as well, doing my research, and I don't think the company will fall from their current highs, but they have been extremely slow in actually returning on my investment currently. So I might sell one share and keep one share and see how that goes and redistribute that money elsewhere on some of the newer companies that have been coming out and that I think have a technological advantage, whereas Amazon have grown quite massively already, so it's kind of difficult to see massive returns on this company. Simon Property Group, for anyone that already might know, they own a lot of shopping malls, so this was definitely a recovery play for me. I thought that in 2021, things will just go back to normal, and I was surprised to see the stocks have actually rallied. All the recovery stocks have done really well, all the way from, I think, October, November, December, up until this point. So that's why I picked it up, and I saw a 65% return on this company. Very nice for it as well. Steve Madden, very nice return of 83%. Now, again, picked it up, just a recovery play. I do like the brand. I do wear the shoes sometimes, although if I can thrift them, that's how I'm gonna pick them up, because spending $100 on shoes is definitely not for me. I'd rather spend $100 on stocks. Etsy, I do think this company has a lot of potential. Did see a massive growth due to the pandemic. So I saw a really nice return on this company because of that consideration. I did check my numbers, and this did give me 39%, which I'm really happy with. I think that's a very fair estimation for Etsy, and I do think they will keep growing year over year, but I might not be buying too many shares just yet. Cardalytics, this was actually a speculative play from a friend that said that they believe in the company, so that's how I got to know the company. And then I looked some of their numbers and some of their potentials. So definitely read about Cardalytics. Very interesting company to read about, so do your own research, and that's what I mean. As a new investor, it's very interesting to find these companies that you've actually never heard of but have massive potential. So companies like these often are some of my favorite ones to invest in that are brand new. There's not really anything known about them, and they have something game-changing about the advertising industry and so on and so on. So I definitely love to invest in companies like these, but because it was a speculative play and I didn't have all of my numbers done for this company all that much, I didn't invest significantly into this company, and I saw a decent return on it as well at 100% for my investment. And having said that, even though I'm going through this list and we are seeing some awesome returns, there was times when a lot of my list basically that you see here was absolutely red. I'm basically buying these stocks and they're taking my money, and it's like I'm just throwing it into the fire pit and watching my money leave. And that's definitely one of the hardest things about investing. And one of the main things that I'd really like to get across to you guys today, if you get anything from this, is it's always patience and it's always holding till the right moment. And later on, I'll actually completely rebalance all of my portfolios. When my 1 year comes up, I'll actually sell some of the companies that I think have become way overvalued for what I initially believe the company should be trading at. And that way I protect my investments and I actually realize some of these gains, because the important thing to realize, let's take example Lemonade. Even though I got 220% return on my investment there, because I didn't realize those gains, that can go all the way down to zero if the investors pull out. I don't think that's realistically gonna happen. However, until you actually sell the stock, you haven't realized those gains, and the return is actually not really yours up until that point. But I do love holding in for the long term, as I believe that is the best strategy out there, and not panic sell at any moment where the market goes down 10-20%. That's just bad decision, I think. And I hope you guys noticed by now that some of my greatest returns have been on companies that have been completely struggling at the time, whereas Lyft and Uber, they were struggling, and that was a really nice return for me. And then the recovery stocks, they were struggling a lot, so that has been a really nice return. So it's investing during times that people don't want to invest in a company and don't believe in the company. And I'll definitely show you some of my most recent purchases and how poorly those are doing, but I do expect them to do much better in the long run. JP Morgan, I do want more bank stocks, and I do love the bank. I actually bank with them. So that's how I ended up learning about the company, is through doing banking business with them. And I ran my numbers on them and it looked like a decent buy, and I actually picked them up when all the bank stocks were crashing. So I saw a really nice 50% return on this one. So Lyft, yeah, this is the one that I was talking about with Uber. This one saw a really nice return because I picked it up during their absolute worst times with the California lawsuits and everything like that. So definitely always pick up a company when it's struggling, but number one rule is double check and make sure that it won't significantly impact their revenue, or if it does, that there's chance that their management team will actually figure out to turn that around, such as Lyft and Uber figuring out with California on the whole situation that they had here and actually getting through all of the rules and lawsuits and resolving the issues. That's very important to trust the management team. Johnson & Johnson, actually really disappointed in this investment. It was completely flat for a really long time. I was losing money on it for a really long time. Now it's sitting at 12% return, which is okay, but I'm definitely gonna be selling out Johnson & Johnson. I don't think it's for me. I don't think I will be keeping it for the long run. It's just too little of return for my time and the time that I spend researching the companies and actually dedicating the time to look at the numbers, look at their financials, and so on and so on. I don't think this is a good buy for me. Apple, picked it up because everyone's got to own some Apple. I do believe in the company, even though I don't use their products. I think it's fantastic business and they definitely know how to make money, but I do think that comes at the expense of the customers. So I bought a little bit of shares, nothing to do with the iCar or anything like that. It was all to do with the iPhone 12, which I thought was one of the better phones that they have released in a long time. And that studies have showed that this year is the cycle year for the iPhone, where people will actually go ahead and upgrade to the iPhone 12. And I purchased this super late into the season. I think this was a September or October purchase, so I don't see that high of returns on it yet. Having said that, that was only a few months ago, so I do believe in the company in the long run. Southwest, American Express, and GE, all of these were at their basically all-time lows during the pandemic and everything that happened. So I ended up picking up all of them just because I wanted some exposure to the credit market, I wanted some exposure to the airline industries, and I did think that when the recovery time came, that I will see a really nice return on my investments, which definitely has happened here, where Southwest saw 71.5%, American Express 32%, and GE at 85%. All of these are really nice returns. I didn't put significant money on it, so in terms of my entire portfolio, they didn't do that much for me, but I'm definitely happy I picked them up and made the right decision. And what I'm actually most happy about is now I'm realizing the pattern of the decisions that I've made, and I will definitely be a much better investor in 2021, and I'm really excited for the year, even though I think that it might be a slower year, and I definitely won't be buying the stocks at a huge discount like I did in April. I actually ended up missing March because I thought the market will keep going down further. Little did I know though. So I ended up picking up in April, and that gave me a good boost on all of these recovery stocks. Having said that, if I did redo everything that I did in 2020, I would have focused on tech and then picked up recovery stocks come September, October, and so on. And obviously nobody can predict the future, but one thing I can tell you is buy and hold. Berkshire Hathaway, now whenever a new investor starts to learn about investing, the very first person they learn about is Warren Buffett. And that's how I got familiar with their stock, and then ended up picking up some shares. They've been underperforming for most of the year basically, and then I think they got a nice bump just recently, a few months ago. So I'm not too thrilled about this purchase, but it is 30% for the entire year, which is really nice. Having said that, that is with the stock being down in April. So I'm not sure that this will continue on year over year, and I'll probably won't be buying too many shares of this company in the long run. Now we also have Delta Air here and Guess, both of which saw huge recovery percentage. Delta Airlines saw almost 100%. So again, it was a case where I held the company in my other portfolio, couldn't add to it anymore, so I ended up picking up a little bit in this portfolio just to see how it's gonna go if I bought it at the absolute low, which I think in this case I actually did just that. And then Guess, a massive 200% return, 220% return actually. I've done really well. Now, if I would have known that they've done this well, or they would do this well, I definitely would have put way more money into it. But since it was a speculative play and I didn't really do my research on this company all that much, I hardly put any money into it, and that goes to show in this portfolio. Now, Intel, I do believe in Intel in the long run. However, they just had really bad luck with issues with the new chips coming out and everything like that. But I do believe in the company, so I do want them to get over these hurdles. I am putting a pause on me buying the company just because I think it's gonna be a while till they recover and investors actually pile in. Because one thing I learned this year is investors pile into companies that are actually currently moving and not stagnant. And that's what I kind of want to do with Intel. I want to give them another year and then start buying, and hopefully I buy still before institutional investors pile in and anything like that, just because I do believe in the company, but I don't want to hold it while it's not moving, just because in the long run, it's just not good for your portfolio when your numbers aren't going up. And if you can get higher returns for other companies, why invest in a company like Intel, which has had no growth for the better part of this year and probably all of 2021 maybe, but we'll see how that plays out, and I will be keeping an eye on this company for sure. PayPal, definitely will be investing into this company further on with all of their involvement with Venmo and Bitcoin and so on. I think this company will go on to do great things, so I will be adding more to this company. So far they have been a little stagnant, but I did purchase these shares not too long ago, so a 20% return so far is not so bad. AMD, now holding AMD and holding Intel is definitely controversial. I did want to pick up some AMD after I learned what of a cutthroat CEO the company has. She's a really impressive woman, and she's gonna do great things for the company, and that's why I will keep buying this company in the long run and will keep enjoying the growth. Having said that, the stock is a little overvalued, so you do have to find the right target price and the right price point to actually buy into the stock. Microsoft and eBay ended up buying these companies later on into the year, so the return is quite small, and we're seeing only 10% for eBay and 15% for Microsoft. Now, have I bought in April? This would be a completely different story, but I still wanted to have more exposure to companies such as eBay and Microsoft, so technology companies or e-commerce, I guess, for eBay in this portfolio. So I did pick up a few shares of these. And now next we have Park Hotels, Live Nation, MGM Resorts. All of these were recovery plays, and that's why these companies saw a great return. And have I had more faith in them? back when I started investing, I would have had much higher returns in terms of actual cash value than percentage, because the cash value is what we actually care about, the return of your money, not the percentage. It doesn't matter if you invest $2 into a company and you see 2,000% return. You can't really say that you've done really well investing. You do have to put your mouth where your money is. And I was definitely extremely cautious this year, being a brand new investor and investing in such a volatile market. So I didn't want to put too much money into these stocks, but I did get some exposure to them, and I got some rewards for the risk that I'd taken. With Park Hotels having 117%, Live Nation 103%, Visa picked this up a little bit later, so it was 20%, and then MGM Resorts at 123%, which is all really nice numbers, but I didn't end up buying that much of them, as you can see here. So the return on my investment at the end of the day is fairly low. Regions, I'm pretty sure that was a free WeBull stock. I think there's 5 of them, because I actually don't know anything about this company. I don't remember researching it, and that's the only way that actually makes sense. So I'll probably be selling these in the near future. Bank of America, again, I just wanted more bank exposure, and the company was being punished. I think this was a point where it was much lower than some of the other banks, so I ended up picking it up, and I saw a decent return of 55%. Again, I didn't buy that many shares though. And that's why we're getting to the bottom of the list. So this is where it's some of my lower returns, where the percentage might still be high, but I didn't put that much money into it. NEO, picked up 1 share of NEO just to see how it goes. Similar to Tesla, I don't believe the company deserves to be trading where it's trading. I definitely would love to own the stock, but at these levels, it's just not for me. I did see a nice return of 51% on the company though. Oracle and HPE, these were further technology exposure. I will be looking at these companies and deciding on if I should invest in them in 2021 or should just sell out and forget about them for now. Now ZNGA, I'm pretty sure this was a free stock. I didn't want to purchase this company or anything like that. This was a free WeBull stock, and it saw a 9% return, so that's nice. We got Walmart. Everyone's gotta own some kind of retail, so I did pick up Walmart. I did pick it up late. Some of my other portfolios do have a higher return on Walmart just because I bought them at the right time, and I wanted to have Walmart in this portfolio, but it wasn't the best of times, so I didn't end up picking up that many shares here. American Airlines, again, my stocks were down in another portfolio, so I just picked up 1 share here. Nothing crazy. DHT Holdings, I have actually been waiting for this company to go green for me. They were red for a big portion of the year because I bought them at the absolute peak when everyone was talking about the oil tankers. So I picked up the stock, and next thing I know, it completely crashes. Luckily, I didn't invest that much money into them at all, and they were paying really good dividends. So I kept it for now, and I'll probably sell out of it as soon as possible. Home Depot, so I picked this up not too long ago. I actually covered this in my video on how to value any stocks, and I do believe this company will do really well in 2021, so I'm holding it for the long run, and they are paying really good dividends, so that's definitely a hold for me. Alamos Gold, no idea what that is. Pretty sure that was a free WeBull stock. Now, AT&T, also covered this stock in my how to value any stock video, and I definitely don't believe in this company at all anymore. I did at the very start when I first started investing. I figured, you know, dividends is a great way to go. But looking at the stock and looking at the company's revenue and looking at their projected revenue year over year, they're not looking too great for me. So I'll definitely be selling out of this one later on. Nordic Tanker, same story as DHT, where I bought this at the absolute peak and I'm actually still down 15%. Thankfully, it was a speculation play, so I didn't lose that much money on it. And I definitely learned a lot just by investing a few dollars into it. And that's exactly what I did with some of the other companies such as Guess and so on. I invested a little bit just to see how it's gonna play out this year, not believing in the company and it being a speculative play. I don't like to put any sort of money into it, but putting $20, $30, it helps me learn a lot more versus if I did paper trading or didn't invest in it whatsoever. Because if I didn't invest into it, I would have completely forgot about the company or ended up making the mistake down the road again. Market value of $137, that's definitely such a small amount for an investment that I can definitely learn from my mistakes and I will remember this lesson, but it won't hurt me in the long run, and it doesn't really hurt my portfolio all that much. Alibaba, now this is my most recent purchase. I do think the company will work out the issues it's currently having with Chinese government and all the pressure that it has seen from America. So I just picked up this company, and this is exactly what I was saying. Every single one of my buys that I just purchased have always been in the red and end up doing really well towards the future. So I do think this company will start to do much better in 2021 because they're absolutely crushing it in terms of their revenues. They're just going through some of PR issues and some of government issues and so on and so on. And all of these issues have added up to investors not believing in the company and saying it's a massive risk to buy a Chinese company. And I agree. However, risk reward, the higher risk you take, the higher reward you will see. So I did put $2,000 into this company, and we'll see how that plays out. And that's because looking at the numbers, the company is doing extremely well and there's no issues with their revenues. They're just going through some hard times right now, which have impacted the way that investors see this company. But I do think the company will do better in the future, and I will be holding it for the long run. Lastly, let's talk about Bitcoin. I ended up picking some up as recent as a couple weeks ago, and it's actually been doing really well for me, 16% in less than a week actually. And that's really awesome to see. And I have started to believe in cryptocurrency more and more, and I will be investing in it more in the future. I do think Bitcoin is here to stay. And the fact that financial institutions are accepting Bitcoin and all of them are talking about it, and there has been a lot of exposure to Bitcoin, and PayPal has accepted it, and so on and so on. I think it's definitely here to stay, and I will definitely be investing into it further. Having said that, this is the riskiest investment I hold in my portfolio. Yes, even more riskier than Tesla and Alibaba. So definitely the most riskiest play, but I think it is gonna be the most rewarding as well. So we'll be holding this for the long run. Now, one of the last things I wanna do is, this was actually my active current stocks that I have. I also have realized some gains and I have realized some losses. So let's go through those real quick. So just for complete transparency, I'm just gonna scroll through this list. You guys can take a look at it. You can pause at any moment and check it out. And this just to show you guys that I haven't sold all of my red stocks right before filming this or anything like that. And they have been some gain stocks as well, like Bed Bath & Beyond. When I first saw the company, I picked it up and it saw a 30%, I saw a 30% return on it pretty quickly. And I thought, wow, 30%, that's absolutely amazing. And I didn't realize that it's actually realistic to get 100% on your investment, 200%, and so on and so on. So I was like, whoa, this is crazy in such a short time, 30%. So I ended up selling it, and that was a huge mistake on my part. I definitely should have realized that stocks can go as high as 100, 200, and the sky's the limit actually, or rather the moon if you're investing in Tesla. So down here, you can see that my only realized loss so far has been Gilead Science, just because I really wanted to get out of this stock. I didn't think it was gonna do well in the future. I really didn't like holding it. And I think I bought it at a really bad time when everyone was talking about remdesivir. So I sold out of it just because I quickly realized that I just FOMO'd into it. So I quickly got out of it and put my money elsewhere. So all in all, for my 8 months of investing in 2020, you can see in the top left corner that I have seen a 26% return, and that includes the cash that I hold in the account and some of the big stocks like Amazon, which I have 6,000 in, which has been returning 3%. So that definitely diluted my return, which is completely fine with me. I'd rather be very safe with my investments and what I do with my money rather than losing a lot of my money or having a lot of red stocks in my portfolio as well. So what do you guys think? Having 27% return in your first year, is that good or bad? Let me know down below. And also, one thing I want to mention is I continue to invest in this portfolio through the year. So as you continue to invest, your percentage of return keeps going down because you're basically diluting your return, your average price point that you bought or average cost for the stock actually keeps going up, because if the stock is going up and you keep buying the stock, your average cost for the stock actually keeps increasing as well. So your percentage of return goes down, but what's really important is that the money that you get from that still goes up. If you believe in the company and you keep investing in it, what you care about is the money on your return. So having said that, and considering the fact that I have invested $30,000 spread out all the way across this entire year, I think it's really nice to see a 26% return, because if I had invested $30,000 at the very start of the year, I do believe my return would have been closer to 50% or 60%, but none of that matters whatsoever, because in the long run, all you care about is return on the stocks, not the percentage return, but the dollar return on your stocks. Now, do you guys want to see some of my other investment brokerage accounts? Please let me know down below. One last thing, definitely check out how to value any stock video, description down below. I think you'd really like it and you will learn a lot from it. Thank you so much for smashing that like button, watching this video, and subscribing. I'll see you next time.